Welcome, everyone. Today, we're going to unpack the absolutely wild story of gold, from its historic highs to a shocking plunge, all in a matter of days. So, after a year that was nothing short of incredible, gold just took one of its worst tumbles in over a decade. And it's got everyone asking the same big question. Okay, let's just dive right into the numbers here, because they are staggering. On Thursday, gold hits this unbelievable all-time high. We're talking nearly $5,600 an ounce. Then, boom, not even 24 hours later, it absolutely craters. I mean, the kind of move that just evaporates trillions in market value from gold-related assets. Just think about that for a second. So you gotta ask, right? How in the world did we get to that record peak in the first place? Well, to really get it, we've got to rewind and look at the historic run-up we saw in 2025. And that brings us to Act 1, the Great 2025 Rally. I mean, the story of that year was just relentless, an almost unprecedented surge for gold. And check this out. What's so wild is just the scale of this outperformance. Gold's price just rocketed up by about 65%. That's its best year since 1979. It left almost everything else, including US stocks, completely in the dust. Truly a once-in-a-generation kind of performance. So, what on earth was behind this incredible run? Well, that takes us to Act 2, why gold surged. And let me tell you, this was no random event. It was the perfect storm of powerful global forces, all pushing investors toward the metal. And you can see the main drivers right here. You had all this geopolitical uncertainty, pushing investors towards safety. The US dollar was getting weaker, which makes gold cheaper for buyers overseas. And here's the big one. The Fed was cutting rates. And that makes a non-yielding asset like gold look so much more attractive. All of this was just amplified by huge investor demand through things like ETFs, making it super easy for anyone to jump in. But here's a really crucial point. The sheer scale of the institutional shift. We're talking about central banks, especially in emerging markets, buying up gold at a historic pace. They were basically diversifying their reserves away from the US dollar, and that created this massive, steady demand for gold. And this huge institutional move really shines a light on gold's most famous, most enduring role. Which, of course, brings us to Act 3, a refuge in chaos. It's pretty simple, really. When confidence in other stuff, stocks, government bonds, starts to fall, investors often run to gold. It's seen as this reliable store of value with basically no counterparty risk. It's something you can actually physically hold in your hand. Yeah, and this quote from the investor Frank Justra just hits the nail on the head. In a world full of digital assets and super complex financial instruments, there's this growing desire for something tangible, right? Something real, especially when the financial system feels a little shaky. So that's the core belief, right? That's what drove the price to those record highs. But with all that momentum, with a story that seemed totally unstoppable, what could possibly trigger such a dramatic U-turn? Well, that's what we're going to dig into in Act 4, explaining the sudden drop. The answer came crashing down on Friday morning, and it had everything to do with the future of U.S. monetary policy, and specifically, who would be leading the Federal Reserve. The trigger, the key moment, was the nomination of Kevin Warsh as the next Fed chair. Now, in the market's eyes, Warsh is seen as a hawk. He's a critic of that ultra-loose monetary policy, which means he's way less likely to support the easy money and rate cuts that fueled gold's amazing rally in the first place. And just like that, this news completely flipped the script. The entire market narrative changed in an instant. The expectation went from more rate cuts and a weaker dollar, which is perfect for gold, to a stronger dollar and maybe even higher interest rates. And that makes a non-yielding asset like gold way less attractive. Almost overnight, the rush for the exits was on. So all this chaos, all this turmoil, it leads us to the one big question that everyone's asking now. Which brings us to Act 5, forecast for the future. Was this Black Friday event a real long-term trend reversal? Or was it just a short-term shock to the system? All right, let's take a look at what the experts are predicting for the rest of 2026, now that some of the dust has settled. Okay, so even after that insane crash, you can see here that a lot of the big banks are still pretty bullish on gold. I mean, look at Goldman Sachs. They're targeting 5,400 bucks. JPMorgan is over 5,000. Their whole argument is that, yeah, the short-term shock of a new Fed chair is real, but it doesn't just erase those powerful long-term drivers we talked about, like massive central bank buying and all that geopolitical risk that's still out there. So what's the takeaway here? Well, it looks like the path forward is probably going to be a lot more volatile, but the underlying case for gold as a strategic asset, that seems to still be strong in the eyes of many analysts. In fact, they might even see dips like this as a potential buying opportunity, not the end of the whole cycle. You know, when you zoom out, the story of gold really asks a much bigger question. It's about where we place our trust and our value in these really turbulent times. Is it in currencies that are managed by central banks, or is it in a tangible asset that's held its value for literally thousands of years? And just before we go, a quick but important reminder. This content is purely for educational purposes. It does not constitute financial or investment advice. You should always do your own research or talk to a professional.